So now what I want to touch on is something we mentioned earlier, is that whether you invest in bonds in a taxable account or in a retirement account, it's not solving this, or addressing this interest rate credit risk problem, which is essentially looking at the fact that yields are at historic lows, and if interest rates rise or credit risk spreads increase, they pose significant upfront losses. So let's just take a look at the severity of those losses and why it's important to acknowledge that in your financial planning. So why is interest rate risk a problem with low yield bonds? Well, low yield bonds are subject to mean reversion. In other words, if they're low yield now relative to the historic mean, which is higher, that over time that it will revert to those long-term interest rates, right? And that could happen, if the Fed stops suppressing interest rates as they are in today's environment. The economy, fully recovers and gets on a less volatile path. And if the Fed increases interest rate to fight off inflation, again, you're posed with this problem. Another issue that could happen is that the market loses faith in issuers' ability to pay back bonds, so credit risk spreads increase. And obviously, what people might not be aware of is that low yield bonds have a higher duration, or in other words, higher sensitivity to interest rate risk, right? So again, the lower the bond yield is, the more clients will lose if interest rates rise. And we'll see that later on in a following slide. So what happens if interest rates are at 2% and just rise by 1%, right? Let's look at how sensitive low yielding bonds are to a change in interest rate, right? So let's say you invest in a bonds of various terms. There's a 10-year term bond that matures, a 20-year term bond, and a 30-year bond. Well, how much will you lose, or clients lose, if interest rates rise by 1%, right? So they go from 2% to 3%. Well, if that happens, the immediate loss on market value of a 10-year bond will be about 8.5%. A 20-year bond is about 15%, and a 30-year bond is 20%. Again, longer-term bonds do have higher yields, but they also come with higher interest rate risk, and that's why when clients are nearing retirement, typically the bond allocation is to kind of more intermediate-term bonds as opposed to the long-term bonds, because advisors realize that long-term bonds will be subject to interest rate risk, and that same sequence of a return risk that they were worried about with the equity portfolio, they'll experience in the bond portfolio if interest rates rise. So the traditional strategy of the 60-40 strategy is 40% are in bonds, but most of those are shorter term bonds. Again, which if you're going for shorter term bonds, you're not really getting much yield. So now let's look at so let's say interest rates do rise. I've allocated my clients to a bond strategy, probably, more shorter term bonds. How long will it take of investing at the higher coupon rate? Because again, if interest rates rise, it went from 2% to 3%, which means in the future, they'll be getting that 3% return, right? So how long will it take me or my client to get back this 8.5% that they lost initially, right? So it'll take them about 4 years if they're investing in mainly 10-year term bonds. If they're in 20-year term bonds, it'll take them 6 years just to get back to their original value. If they're in 30-year bonds, it'll take them 8 years to get back to just to make up what they lost on day one when interest rates rose, right? So sequence of return risk means that earning a higher yield on a lower base, right? Because you've lost this base year initially is not an equal proposition, right? So even though interest rates rise, it's going to take you a while to get back to just what they started in, just what they immediately put into those bonds. And the problem is that the entire financial planning did not assume for this reversion of interest rates back to the mean. And so if you're doing financial planning and you did your stochastic models, assuming bonds are at 2%, the whole retirement strategies are dependent on that 2% return on bond yields. But the fact is that interest rates rise. It will take you 10 years of investing in a 10-year term bond just to get back to the 2% yield that you projected, right? So that's those first 10 years, your clients are at a loss, and again, exposed to sequence of return risk. So it would take them just 10 years to get back to where they started, right? If they're in 20-year bonds, it'll take them 17. If they're in 30-year bonds, it'll take them 23 years just to get back, to the 2% yield that was projected, right? In your financial planning scenario. So in this period, right, if this were to happen, while interest rates are supposed to be low for the next 5 to 10 years, if you're allocating a large portion to bonds and then slowly interest rates are rising and reverting back to the mean over those 5 to 10 years, and then going forward, clients will absorb a heavy loss. They'll be making withdrawals at that same time, and on top of that, the client loses income, is subject to interest rate risk, sequence of return risk, and the RIA is losing AUM fees. So again, if you're in 10-year terms, for those 10 years, you had projected AUM fees, assuming this 2% yield. So neither will the client be getting the return they were expecting in their original financial plan, and the RIA won't be earning their fees, right, across their entire book. So this is why interest rate risk poses a problem in a low yield environment for both clients and the RIAs that are managing that. And the 60-40 portfolio doesn't really make sense for either one.